Pillar just closed a 20 million funding round to accelerate a new tool for commodity trading, and that headline matters far beyond a single startup. In a market battered by volatility, traders crave faster signals, clearer data, and greater transparency. The tool aims to compress complex price moves into actionable stories, much like a weather app translates rain into a daily plan. Investors are watching, not only for Pillar's product, but for the broader shift toward data-driven platforms that promise lower risk and higher leverage. If large capital flows into infrastructure for this niche exist, others will follow closely. Pillar is funding a software platform that aggregates price data, risk indicators, and trade signals to help commodity traders decide where to deploy capital. Think of it as a stock chart turned into a proactive decision aid, not a rumor mill. The money will support product development, cloud infrastructure, and customer onboarding, so hedge funds, asset managers, and brokers can test strategies without heavy upfront cost. The company frames its goal as increasing transparency among opaque markets. In practice, this means faster backtesting, live dashboards, and standardized metrics that let traders compare strategies the way pilots compare flight plans. Commodity trading tools have evolved from handwritten ledgers to algorithmic platforms over decades. The rise of electronic markets in the early 2000s shattered access barriers and created a demand for more reproducible signals. Pillar joins a lineage that includes data vendors, trading desks, and fintech startups seeking to monetize analytics. Institutions learned that raw prices alone rarely yield alpha, so risk models, volatility surfaces, and scenario testing became essential. This history helps explain why a modest 20 million round can be more than a splash. It signals a professionalization trend where technology and capital flow together to manage complexity today. As Pillar raises funds and markets digest the news, early adopters discuss integration timelines, data quality checks, and partner ecosystems. Publicly traded commodities have already adjusted to rising data expectations, with liquidity providers and exchanges placing more emphasis on analytics and risk controls. A major oil firm might test a streaming data feed against its existing models, while a steel trader benchmarks a new signal against traditional price spreads. The overall mood is cautious optimism. More tools can unlock efficiency, but skeptical traders still demand robust audit trails, clear performance metrics, and strong cybersecurity before committing capital in real time. Private equity funds, hedge funds, and headcount at commodity desks could gain a new edge from Pillar-style platforms, but smaller players face cost barriers when onboarding data-heavy tools. Large banks may pilot partnerships to defend their analytics moat, while independent analytics startups could accelerate. Producers and consumers of raw materials will benefit from more transparent pricing signals, and commodities exchanges might standardize feeds to support faster settlement. Retail investors, though typically less involved in reverse-engineered datasets, may see increased access via public dashboards or sponsored education programs tied to risk awareness. The net effect is broader exposure. Macro forces shape how quickly data-driven tools gain traction. Inflation trends, central bank policy, and currency volatility affect commodity prices, liquidity, and risk appetite. A stronger dollar can dampen commodity demand while also raising hedging costs for exporters, making faster analytics even more valuable. Trade tensions and supply chain bottlenecks add resilience premium to price forecasts, pushing traders towards scenario testing and contingency capital. The Pillar round arrives as funds seek resilience through technology, not just leverage, aligning with sovereign wealth funds and pensions diversifying into configurable risk tools amid uncertain macro waters. This backdrop amplifies the stakes for participants. Smart money is testing pillar-style tools through pilot programs, with asset managers pushing for speed, transparency, and reproducible results. Banks are negotiating data-sharing agreements while keeping risk controls front and center. Retail channels may access simplified dashboards, expanding the audience for sophisticated analytics beyond the fortress of hedge funds. In real terms, this means more backtests, more live data streams, and more performance metrics that can be audited side by side with existing benchmarks. If pilots prove robust, expect quota-based partnerships, revenue-sharing models, and the gradual mainstreaming of data-driven decision-making across markets worldwide. Any new tool carries risk of overclaim and misused data. If Pillar's tool proves slow, overfits to backtests, or faces data outages, traders pull back and capital wounds deepen. Over-reliance on models can mask tail risks during black swan events, creating a false sense of control. Regulators could impose stricter data governance, forcing price feeds to slow or fragment. Additionally, early adopters might demand expensive customization, eroding ROI. In markets where liquidity is concentrated, a single provider outage could trigger cascading discounts, margin squeezes, or delayed settlements that ripple through supply chains and undermine confidence for all participants. For retail investors, the answer is not to chase every shiny tool, but to build foundational knowledge first. Learn how data quality, backtesting, and risk controls affect performance before investing in platforms or funds. Seek diversified exposures, simple commodity ETFs, broad commodity indices, and transparent fee structures rather than single vendor bets. If you want participation, watch for provider credibility, independent audits, and clear disclosures about data sources. Use simulated tracking or paper trading to understand how tools would perform under different market regimes before risking real capital. Practice patience, diversify, and measure outcomes with disciplined risk budgets consistently. Looking forward, the pillar funding signals a pivot toward builder capital for commodity analytics, not a one-off rumor. If the trend sustains, expect more startups, more collaboration between exchanges, and more standardized data protocols that sharpen price discovery. The winners will be teams that blend robust science with transparent governance, while outsiders watch for meaningful regulatory guidance and cross-border data sharing norms. For viewers, the key is staying curious, evaluating tools on real outcomes, and focusing on risk-disciplined strategies.